Hello everybody. In my last two lecture series, that is on the 25th and 26th, I've discussed about the money market part 1 in my 25th lecture series, and in my 26th lecture series I've discussed about the money market part 2 series. Now, it is very important to also understand that how the money market actually has become a very important component of financial market that I've already mentioned in my last two series on the last two part one and part two of the money market. Today, I'll be continuing with the same session of the same topic. That is the money market, and today it will be our 27th lecture series, and it will be on the money market part 3. Now I have ended with some of the benefits which has been extended to the and what are the benefit that you get out of the money market. One of the very important area is the profitable investments. Now money markets enables the commercial banks to use their excessive funds in their portfolio which is there for profitable investments. How it takes place: the main objective of the commercial bank is to earn the income from its reserve, as well as to maintain the liquidity to meet the uncertain cash demand of its deposits. Now in the money market, the reserves of the commercial banks are invested in near money assets, and these are short-term bills of exchange which are easily converted into cash. Now thus the commercial banks earn the profits without sacrificing the liquidity. There is also another concept of self-sufficiency of commercial banks. Developed money markets help the commercial bank to become self-sufficient. In an emergency, when commercial banks have scarcity of funds, they need not to approach the central bank to get a higher rate of interest. So they can instead meet their requirement by recalling their old short-term loans from the money market. Now, how the money market actually helps the central bank? We all know the functions of central bank. For example, the central bank in our country is called Reserve Bank of India. So, central bank can function and influence the banking system in absence of money market. And the existence of a developed money market significantly enhances the monetary policy transmission and the central bank efficiency. Money market helps the central banks in three primary ways. Namely, there are like interest rate signaling. Short-term interest rates in the money market serves as a immediate indicators of monetary and banking conditions guiding central bank policy decisions. Now, as Chain versus Wurzel, there is it demonstrated that money markets rates respond quickly to policy changes, providing real-time feedback on policy effectiveness. It further shows how segmentation in money markets can affect its transmission mechanism. Then another way we've got policy implementation. Well integrated money markets enable the central banks to achieve widespread influence across the financial markets, sub-markets efficiently. So when the central bank adjusts to its policy rate, these changes transmits rapidly to the interbank markets, to the other financial instruments, and ultimately to the broader economy. Liquidity management of the money market facilitated efficient distribution of liquidity among financial institutions, reducing the need for the direct central bank intervention. Now, the money market approach, or this market-based approach to liquidity allocation, improve the overall efficiency of monetary policy operations. Now, there are limits to the effectiveness of the monetary policy, though these channels are particularly in the low rate environments. Now, another very important area of the instruments. So, what are the instruments in the money market are there? For example, certificate of deposit. In deposits, time deposits commonly offered to the consumer by the banks, by thrift institutions and the credit unions. All the term deposits are the fixed deposits. Repurchase agreement to the short-term loans, normally for less than 1 week and frequently for 1 day, arranged by selling securities to an investor with an agreement to repurchase them at a fixed price or at a fixed date. Money market mutual funds are something like short-term investment fund operated by professional institutions. Money market mutual funds are an investment fund where a number of investors invest their money in the mutual fund institutions, and they can diversify and the funds in the various investments. Commercial paper are kind of short-term instruments, promissory notes issued by the company at a discount, to face value and redeemed at the face value. Euro dollar deposit made in the US dollar at the bank or bank branch located outside the United States, and the Federal Agency short-term securities in the US. Short-term securities were issued by the government-sponsored enterprise such as the Farm Trade System. There is also called federal funds. There is also called municipal bonds, foreign exchange swaps, short-lived mortgage and asset-backed securities. What is so there are the many areas like how that money market account or the liquidity crisis has been handled in the money market segment. Now, for example, if you see that how in the Indian context we use this money market, because when an individual can invest in money market by purchasing the money market fund, for example the treasury bills, by opening a money market account at a bank. Money market instruments are characterized by the safety liquidity with the money market shares, and the money market offer a higher interest rate than normal savings account, but they have a higher account minimum limits on the withdrawals. So another very important thing is this, to understand the various what are the advantages and the disadvantages of the money markets. Advantages, you can say that they're extremely low risk, and they're actually insured also. They are highly liquid in nature, and they have high returns than most of the bank account. But if you see the demerits or the pros and the cons are actually the low rate returns that not paced with the inflation. Not all the money market security are insured and may have a high minimum investment or withdrawal restrictions. So the money market keeps the financial economy in the running smoothly. It allows the savers to lend the money to those in need of short-term loans, and it allocates the capital towards its most productive use. These loans are often made overnight for a few days or a week. The government, corporations or banks use them to meet their near-term obligation and regulatory requirements. But the thing is this, money market in India are basically in and around the kind of investment which has been made without any kind of a geographical constraint. And the financial institution dealing in the monetary system may be spread over a wide geographical area. And this market is viewed as short-term funds. Broadly speaking, money market in India is divided into two parts. One is the organized sector, another is the unorganized sector. Now, in the unorganized sector consists of the Reserve Bank of India. The organized sector consists of the Reserve Bank of India, the State Bank of India with its associate or other nationalized, the PSU banks and the other scheduled and non-scheduled foreign banks and regional banks. Non-banking financial institutions such as the LIC, GIC or any other subsidiary, UTI, they are cooperative credit institutions and quasi-judicial bodies. Now, the money lenders operate throughout the country without any link among themselves. And the two main sources of supply of the short-term funds in the Indian money market are unorganized indigenous sector, organized in modern sector and the unorganized sector. There are many areas like how the money market actually operates within the organized sector and unorganized sector. The relationship of the various instruments across the money market which have been floated. How the Reserve Bank actually controls the money market situation in India. So we will all discuss in our next lecture series. Thank you for joining.